Welcome to another episode of the Barron Report Live. This week, of course, we are covering all things innovation in food service and restaurant. We talk also on a lot of topics around business in general, and today's topics are no different. We're going to be talking about wings taking on pizza in a Super Bowl challenge. Diageo has a fire sale with some of its liquor brands, and Sweetgreen to be the next food unicorn. So let's just kind of jump right into the first topic, being wings. And this is more importantly about Wingstop and kind of their whole approach toward what is now a very successful brand. It's very interesting, too, because if you look at the two challenges between Wingstop and what's happening in the pizza industry, there are some major ripples happening. Let's take a look at Wingstop themselves so you can kind of see where some of the growth factors are and also what's happening within the brand itself. Wingstop's revenue rose 15.5% annually last quarter. Its system-wide sales grew 6.3%, and its net income jumped 33.8%. Additionally, it's also increased its total store count 11.7% to 1,215 global locations. Now, this is a pretty major move when you look at fast casual in general. There's a lot of things that are happening here because what we see is a little bit of a slowing in the fast casual space where someone like this, being Wingstop, is actually accelerating a lot of what's going on. Additionally, they're doing some other things that I think are really helping them kind of move in this direction of winning the wing business or the takeout business over pizza, and that is strategy. Wingstop also doesn't have any face any direct competitors. When you look at its closest rival being Buffalo Wild Wings, Buffalo Wild Wings is more in a big box type approach where they themselves are in a much smaller footprint and they don't necessarily offer liquor sales. So there's a lot of things that are happening there that kind of positions them more strategically and really in a more nimble position to kind of take on the likelihood of someone in the pizza category, which is pretty much controlled takeout, especially around Super Bowl time. Digital is the other thing that is really moving well with Wingstop. It's rapid progress in digital sales, which accounted for over 25% of its sales last quarter, and it's rolling out a nationwide delivery deal with DoorDash. So this could continue to see digital and online sales rise for Wingstop. And when you combine that with a smaller footprint, the fact that they don't have alcohol, the fact that they are moving kind of to the delivery model, especially at the time when Uber and other companies like DoorDash are doing so well, this could be a great formula to see this necessary growth around Wingstop just explode. You can also look at some other things, and this is wing prices. So as you can see in this chart from Bloomberg, a year ago, wing prices peaked in September. Since then, they've slumped about 37%, and now it sets a 4-year record low. So they're primed in a position of lower cost of goods, but yet they've been able to maintain their retail price. And they've pretty much dispelled one of their major competitors in Buffalo Wild Wings. For a national chain, Wingstop bone-in wing costs eased up 11% earlier this year, which contributes to food costs overall, and hence the massive profits they've seen, which were some of the numbers you heard at the top of the topic. Consumer love is kind of the wrap-up of this particular chain and why I think they're doing so well. Wingstop is taking on pizza really in a place that I think pizza has kind of controlled, and that is in the area of consumer sentiment. So consumer sentiment rating 92.8% versus Pizza Hut, which is the number one pizza chain near their size, over 1,000 units, coming in at 90.5 on the consumer sentiment rating. And again, this is consumer sentiment on social media of how you or consumers are talking about the brands themselves, whether it's quality of food, whether it's service times, availability, all those types of things that you might mention on social is what really contributes to the overall look on that. Another thing that you'll see is kind of pizza delivery, which was down in 2017, is taking another hit in 2018. And we did a piece on this not too long ago, so make sure and check that out if you haven't had a chance. As we move into our second topic, which is Diageo, One of the things that if you look at the headline here, meaning Diageo dropping 19 brands, the thing that I think is most interesting here is the fact that they have repositioned the brand to focus on these really high quality brands that lead the Diageo brand group. And where I think that strategy is moving to is the fact that they are not necessarily keeping those underperformers like what you see on screen right now, and now they're shifting that over to performers that are doing great and to be able to take on the craft spirits market. And that's the bigger point here, is that Diageo is really trying to challenge what's happening in the craft spirit business. You know, we have a show called Across the Bar. We get a chance to cover some of the best cocktail makers in the world. And one thing that I've seen when we are out there in the field is the fact that these craft cocktail makers are using some very unique and different cocktail brands. And that, I think, is the reason we've seen this move right here from Diageo. So big move, I think, for Diageo is to really focus on these top brands. They've got a formidable foe, but it's in the representation of what could be hundreds of craft cocktail and artisan spirit makers that are really kind of starting to challenge the market. Let's move on to our headline. And of course, this one is, I think, the big news of the day, and that is Sweetgreen's recent investment and the fact that this company is essentially becoming a unicorn. The company is nearing essentially nearing a $200 million investment with Fidelity Investments. This would put them over the $1 billion mark, which CNBC recently reported. Some other factors that have happened with Sweetgreen, we, of course, identified very early on that this was a fast casual concept that was going to be a star. There's only a handful of those that we've kind of picked and said, could this be the next Panera or the next Chipotle? But Sweetgreen was one of them. Another thing that they did was they moved their HQ to LA in 2016 and considers itself to be more of a tech startup versus a food company. And we reported a lot of this as far back as 2014, that this brand would be, of course, a breakout brand in fast casual. And it looks as though they're definitely here to stay with this kind of money behind them. It'll be interesting to see where this particular brand goes, because I think they've got a lot of flexibility with their Sweet Life conference, or I won't call it a conference, it's their festival. And Sweet Life itself is more of a lifestyle approach to the brand. And as you can kind of see on screen, what this brand is doing is they have something that is really very unique, and there's only been a handful of brands out there that have been able to achieve it. Chipotle was one, this kind of X factor, because Chipotle really had a market position that was not necessarily the top of the game. The leading fresh mix category leader was Baja Fresh when Chipotle hit the scene. But how were they able to basically come in and control the burrito business? Essentially, they have this thing called the X Factor, and it's something that is combining ambiance, food, environment, all of this, much like what Sweetgreen has. And that, I think, is going to be a huge difference in how this company goes to market. Additionally, when you look at Chipotle, and this is one of the things that I'm a little concerned with in reference to Chipotle, and that is the Pershing Square sell-off of $56 million in stock. Not that that's a massive sell-off, but it is an indicator that Chipotle, though their stock has corrected some, is starting to see some challenges and some confidence in the market. So when you look at that, Sweetgreen continues to be what I think will be one of the stars of fast casual, especially with this new Fidelity-led investment that could put this brand in the unicorn status. I'm going to hold my predictions for this brand because I do have some ideas of where I think this brand could be going in 2019 and beyond. Make sure and check out my prediction show, which I do every year, usually in December or January. I give a few predictions that kind of slate out how the food service industry will be challenged, whether it's through technology or market moves, etc. Those are the kind of things that we'll do in that show. Additionally, as you may have had a chance to see some of our, or listen to some of our recent shows, one of the shows recently that I just did on social media topics was with the Payway CMO. Make sure and check that out on the Barron Report. You can catch that up on iTunes. And then also next week, We will be here in studio with Ted Rubin, who is a social media expert and rock star. And we're going to be talking about kind of the state of social media as a whole and where it's going, what's happening. You definitely want to be here for that show. Again, this is a live episode. Hopefully you're going to catch this, whether it's out on one of our live streams, or maybe you're catching this over on iTunes or Spotify after the fact. Make sure and subscribe, listen to us. We will catch you next time right here from the Barron Report.